Got it. So let's say they started a business, they're starting to make some money. And before that, they really didn't know anything about personal finance. Maybe they opened up a Roth IRA, maybe they didn't. Where would you start with them in telling them the first couple of steps that they should take to set themselves up for successful financial future and not make many of the mistakes like buying liabilities and just kind of or keeping it all in cash, things like that?
Yeah.
What's going on, everyone? Welcome back to the Adam Nessum Show. I have another amazing guest with me. We have Aryeh, whose bread and butter is helping successful business owners and entrepreneurs invest their money intelligently, allowing their wealth to accumulate so they can stay focused on what truly matters, their business and mission. I'm happy to have this discussion today because myself as a business owner, as I'm both in medical school and making money from a business, I need to know, all right, am I investing my money in a smart way? And so that's what I'm hoping to figure out today. Thanks for coming on.
My pleasure.
Awesome. So can you just, for the listeners who don't know you, kind of give a little bit of a background of how you got into this world of wealth management, helping online entrepreneurs manage their money and all the other things that you're currently doing?
Yeah, it was kind of by accident almost. So my career path was probably more, I would say like old school, traditional, prototypical, go to college, get a good degree, get a good job, right? And which is what I did. So I went to college, got a degree in finance, and then ultimately went into what we call investment banking and started down the world of what people may call high finance or whatever it is. And I basically have spent, over the last 2 decades working with either inside at and being an employee at some of the greatest or, prestigious large investment firms, or working alongside them as a consultant. So this is private equity firms, hedge funds, alternative asset managers, venture capital firms. And, my day in and day out job is I value investments, I value businesses, and I decide, I help them determine what things are worth and how to make them more valuable. But from the time I literally got my first job, I started basically having other businesses on the side wherever I was, legally and, from a compliance standpoint was allowed to do certain things, which is, the industry is heavily regulated.
I was going to say harder to do when you're already working in finance, but that's good to see you're still able to have the side hustles.
Yeah, exactly. So I got, the first things I got into were like physical products because that has no regulatory issues and things of that nature. And by nature, I guess I'm just like intellectually curious. I'm always wanting to learn about different things. And I was always testing like little different businesses along the side because I was like, oh, does this work? And does this speak to me in the sense that like there were businesses I tried and I was like, oh, this works and this makes money, but like, I really don't like this business. It's making me very uncomfortable, and not from a, ethics perspective, but much more about how you have to go about doing it or scaling it or whatever it is. So while doing that, I learned, I had the finance background, and as a business major, you take marketing and management, all these things, but I learned so much more about marketing and email marketing and social media marketing, all these things from whether it was courses or books or just meeting other people online and really getting into it. And I love the psychology of business. Like I love business and I love the psychology of business. And I guess like, if you really go back, when I was a kid, I used to deal in sports cards all the time, and it was like my stock market. And I would, basically buy the players who I saw were going to go up in value before the market recognized that the card was worth more. And then I trade out of them and stuff like that. So,
so you're an entrepreneur from the get, it seems like.
And I didn't know that back then, I think. I think it was also when I was younger, it was not as common. It was like, you didn't go and work for yourself. So the idea was probably was scarier, not to say it's not scary now, but it was even scarier then, given the timing of that. But anyway, I started to meet a lot of successful online business owners. And what was really interesting was the first thing is they were like, I have this money. What do I do with it? And some of them, go through the path of like spending it on stupid stuff, wasting it, right? Like buying liabilities or whatever it is. And then some of them were like, hey, I want to invest it, but I don't know what. And now obviously with the craziness that is now the market, because it's just been, retail investors now can actually have a real power versus, 10 years ago, 5 years ago, it wasn't the case. But crypto, all these things, like like real estate, this,
Yeah,
that,
there's
the
so
other
much.
thing. There's
Like the
so much,
GameStop
right?
stuff that was going on.
Yeah,
That was what
exactly.
you were referencing.
Yeah, meme stocks and stuff like that, GameStop and AMC, and there's like a whole bunch of other ones that I'm not going to list like to pump them, but you know, the craziness of that stuff, like people are now between social media and YouTube and these things where information is flying everywhere, like who to trust, what to do, you know, hearing a good idea, is it a good idea? Do you want to research it? And if you're actually running a business, do you want to take time away from what you're doing and you enjoy to make your money make money or do something else, right? Like I always reference, like, you know, when you see these courses that are teaching you, I can teach you to trade options. Okay, but you know what? It's going to take time and you're going to have to focus on this. And if you are, let's say, a doctor and you're called into surgery, you can't be like, oh, hang on, I need, you know, I need to see this trade through,
exactly.
right? Like I got to put my stop loss in or the upside and, you know, whatever. Like, are you a day trader or are you, you know, a doctor or whatever it is? And so people just started coming to me because what I took for granted, both between personally learning it as well as professionally learning it, I just started to be able to help people because, and it was really interesting because I think a lot of people weren't even sure like where to go from, you know, just like conceptually ideas where to go. But the other thing is that the reality is like 9 out of 10, the problem is the industry, the financial industry in particular, everyone's selling, everyone's offering the solution of what they're selling. Meaning if you came to me and you're like, I don't know what I should do. If I'm a life insurance guy, my solution is buy life insurance, right? Because that's how I'm paid. And if I am a stockbroker, or, you know, that was a classical name, but like if I'm a wealth advisor or whatever the heck you want to be called at a Merrill Lynch or a Edward Jones or any of these places, I'm more or less incentivized and paid strictly by, you know, getting you to put money into our funds and get fees
and then they
way,
carry
right?
exactly. Yeah.
Right. And so the real challenge is like, okay, where can I go with real knowledge and not be sold on something and have that true, what I would have called an advisor, but now like a financial advisor, it's almost like has like a connotation to it. Right.
Right.
And like, so a lot of people, like I tell people like I'm a wealth architect from that perspective, because like I'm designing your future, like I'm building it for you and I'm not managing your money. I'm actually just they're working with you to help you understand these things, even if it's just like free education, because there's real need out there. And I guess it was not recognized in my mind, you know, earlier.
Got it. So let's say someone they started a business, they're starting to make some money, and before that they really didn't know anything about personal finance. Maybe they opened up a Roth IRA, maybe they didn't. Where would you start with them in telling them the first couple of steps that they should take to set themselves up for successful financial future and not make many of the mistakes like buying liabilities and just kind of or keeping it all in cash, things like that?
Yeah. So I mean, obviously it's very broad, generic thing, but I think like the younger you are, the easier it's going to be. Like the earlier you start all this stuff, you're going to be able to accumulate so much more because of things like the power of compounding, right? Like people don't like one of the things I always joke about is investing. If you actually do it right, it totally can be wealth building and investing totally can be boring. It can be one of these passive-ish things. And I say ish because if you just do some of the right boring things, you're going to get there. And I think a lot of people assume that like investing is I have to be able to go to the next dinner party or cocktail hour and talk about my winning home runs that I picked this stock that like 10,000x, right?
Right.
Versus like I bought the S&P 500 and it compounded
every month.
Yeah, exactly.
25 years.
Yeah, correct. So like, the way I think about it is like if someone's like, hey, how do I start going, right? The first thing to do is I have no problem with debt. My problem with debt is consumer debt in the sense of like, you know, credit card debt. But obviously most medical students are going to have, you know, student loans. That debt was a means to an end, right? Like it was a means to get you the job and the lifestyle.
That was an investment in future income potential.
Correct. But the simple way to think about it is like, okay, let's use the S&P 500 as a very fundamental example, right? So for anyone who's listening who's like, I don't even really know what the hell the S&P 500 is it is, you know, an index, basically a composite of the 500 largest US based companies, right? And they figured out like, hey, if we put the basket together and we said, hey, you can invest in theory a slice of 500 companies, that is what the S&P 500 index does. And there's lots of cheap ways to do it, things like Vanguard or anybody. And, you know, there's mutual funds, which is basically the same collection The mutual fund is this S&P 500 index, or you can have something called an ETF, which is an exchange traded fund, right? So it trades just like a stock versus a fund.
But usually for like an industry, right? So you'll have.
Well, you could do, they have ETFs also for the S&P 500, but it could be industry. It could be.
Right. Okay. Yeah.
So it mimics, think of it as the exact same thing as a mutual fund. The way I tell people is the two differences between ETFs and mutual funds is 20 years ago, ETFs really didn't exist, or 25 years ago, they didn't exist. Like it's a variation. The fees are slightly lower on an ETF versus a mutual fund. And the weird wonky thing about a mutual fund is typically it has higher investment minimums, but it also actually, this is a thing that most people don't realize, is an ETF trades like a stock, meaning from 9:30 in the morning till 4 p.m., it trades every second. You can get in or out at that moment. A mutual fund trades one time, and that is at 4 p.m. every day. So if you place an order to buy or sell a mutual fund today, it will not transact till the closing. So if you buy it thinking the market's down and the market ends up being up, you will have bought it when it was up versus an ETF, you're buying it at that second. And otherwise, they're more or less the same. And certain investment vehicles like 401ks don't have certain flexibilities where they only use mutual funds. But not to bore everybody with the details, let's kind of get back to, what people can be thinking about is, if you think about the S&P 500 index and you're like, okay, what does that do for me? Okay, if we look at historical averages, people tell you it's like 8-9%, whatever, but that's like over literally like 100-year span, right? And so the thing it doesn't think about is like the ups and the downs. And it takes the averages, which is kind of like, it's good and it's bad, but if you're down 50%, you actually have to be up 100% to get back to even, right? And that's just like a simple math. So if you think about the S&P 500, even over like the last 10, 20 years, you're actually talking more like a 14-ish % kind of rate of return. And we're in probably like the biggest, longest standing bull market that we've ever really had.
It's been pretty good lately.
Yeah, exactly. Like we probably have I think we're in year 12 or 13 of a bull market. And typically they're like 7-8 years is like the longest duration. But if you put in money every single month, right? So it's what we call dollar cost average. It is as super boring as it gets, right? Like it's going to pull from your bank account every month and it's just going to buy whether the market's high or whether the market's low. It takes the emotion out of the whole thing. Now, the reason I bring this up is if you have a student loan and you're like, oh, well, I want to get rid of my debt. Let's say your student loan is at what, 3%?
It depends if you refinance. Some of the government loans for medical school, they vary between like 5 and 7%. So they're higher. And then if you do like, a private loan, then it could be different. But if you refinance, then usually you're getting closer to like around 4%. After medical school. Yeah.
Okay. So after you refinance and you're at like a 4%, even if the S&P goes back, it reverts back to its 100-year average, right? Of 8%, you are effectively getting an extra 4% return versus if you throw all your money at the loan. So the way to think about debt and loans is whatever your interest rate really is, that is effectively your rate of return, which is why like I think a lot of people have this idea of like, oh, I want to pay off my house early. If I make these payments extra principal, I shave the amount down from 30 years to 15 and I only pay X% in interest. All true statements. But if you think about it, what you're actually doing is you're taking, let's say you've refinanced your home now and you're paying 2.75 or 3% or 3.25. You're effectively taking that money and that's all you're earning on it. You're earning
instead of having it in the market at, let's say, call it 10%.
Correct.
Yeah. No, that's like the age-old question is, do you pay the loan or do you put more towards investment?
Right. And so I think it depends on the rate on the loan, right? Like it really, it depends. And also how long that loan has. Like so I don't know student loans perfectly, but some loans, you can create loans that have like basically a 10-year loan, but it really amortizes over 30 years. What that means is those first 9 years, you're paying as if it's a 30-year duration. So it's smaller payments. And at the end of year 10, though, you have a massive balloon payment that's due. Like it's very standard in real estate, like, not personal real estate, but like commercial real estate, like, apartment buildings and stuff like that. So I don't know if student loans have that, but depending on what your debt looks like, credit card debt in general is it's aggressive, egregious rates, 12 to 21%.
Right. So it's like, if you pay that off, at least you're in essence making 12% if it would.
Correct.
Yeah.
Should you have that? That's a whole different discussion. Probably not. So the person person who's starting out, right? Like a Roth IRA, because when you're a student, you qualify for a Roth in the sense that like there's a point in your life where you will hopefully not qualify for a Roth. And that is like when you're making too much money, you can't use a Roth, right? And it's not that high of a number, right? I think it's like 100.
It's 100 something thousand.
Yeah, maybe 180,000 combined. I don't even remember anymore. But the Roth, basically what that says is you pay taxes on your earnings today. And after you've paid your taxes, you put the money into this thing. And there's like a $6,500, a year cap. You can't put more than that in, right? But there's a couple of really interesting things on this. Number one, you never pay taxes on the gains, assuming that the tax laws don't somehow change in the future for this, but whatever. You don't pay taxes on the gains. So if this thing is growing tax-free forever, that's pretty intense. And the other thing that I think a lot of people don't know about the Roth, it has like this interesting wrinkle as well. And that is the problem with like a regular IRA and a 401k is once you put that money in, you cannot take it out till you're 59 and a half unless you want to pay penalty. The Roth has this interesting nuance that says you actually can take out the principal of the money. So let's say you threw in $6,000 this year and it grew and it grew and it grew. And like 5 years later, you've got whatever, 20, 30, 40, $50,000 in there, but you need $6,000. You can take out that $6,000 without paying any penalties on it and use it.
That's interesting. I actually didn't know that. Also which is why Roth is such a good vehicle, in my opinion. Do you advise your wealthier clients to do a backdoor Roth if they can?
So it all depends on a lot of things. So it depends on what else they have going on in their life, whether they have certain tax planning and strategies in place. If you can get it done, because it's not like a super simple thing, then potentially it may be a good idea. But it also, I think, depends on your overall strategy. And the challenge with the one thing I always tell people is, sure, the Roth allows you to take out principal, without penalty, but everything else, all the gains, you can't touch till you're 59 and a half. And so the question really becomes like, who is your tax strategist and who's your tax advisor? Because sometimes you're going to need that money. And once it's in that vehicle, the outside of the principal, it can't be tapped. And the second thing is a function of, are you using a self-directed, meaning self-administered account? Or are you just using like Fidelity, Schwab, or any of these normal platforms? Because the limitations with those platforms is you're using either stocks or mutual funds or bonds or, things of that nature. Whereas a self-directed that you are self-administered, really is the right word, self-administered one, you can start to buy assets like real estate. Whereas
in your Roth, you can even buy crypto, I think, if you've do it properly.
Yeah, there are I've seen a few platforms now that are coming out with that they're offering that as well. Yeah.
Interesting. So, I mean, for like new high income earners, right? Which usually, a lot of our audience is residents who are going to become attending physicians who go from like making 65,000 to 300 plus in the span of 1 year. And then entrepreneurs as well. What are some of the things like you would tell them to do first?
Yeah. So the first thing is while you're in that lower income, right? That's when you set up these Roths, because these are very valuable, because you can't, once you become that high earner, boom, you're out. You can't do that anymore. The next question that I tell people to think about before I give them direct specific things like do this is ask yourself, like, do you envision yourself doing this for forever and ever and ever? Like, I love helping people. I'm in medicine, or I love my business. I want to be doing this for forever and ever and ever. Or do you ultimately say, it's kind of a means to an end, and my end is freedom in this way or freedom in that way. Right. Because, there's all these things out there like the FIRE movement and things of that nature. And I think the important thing that people need to understand is getting real with themselves about what they want their lifestyle to look like. And that means everything from time to also spend. So it has nothing to do with like, what is your budget, quote unquote, but like actually understanding what your annual spend looks like. I think, most people, especially people who start to really make a lot of money, is they start to not pay attention to that because they're like, I make enough. What does it matter?
Yeah. Yep.
Right.
It's like, and then if they're not going to be making that same income to keep that same level of spend, you have to really know the numbers and how they work out.
Right. And even if you want to keep that spend up, right? And even if you do make that for, let's say, 30 years, okay? At the end of 30 years, though, what do you have waiting for you on the backside? And so some people want to own an apartment building. So that's going to cash flow enough for them that will throw off enough to replace their income. Okay, that's fine. Understand, though, that, who's managing that building, who's maintaining that building, who's running that building, who's leasing it up, who's doing the repairs, all that kind of stuff. But on top of that, there are other ways to do this, right? Like there's the model where you basically build a pot of money, right? Like a pot of gold, and you're going to run it off over the next, whatever, 30, 40 years of your life or 50 years of your life. And so you need to accumulate that, because ultimately you're going to draw down, going back to the point is like, how much do you spend a year? Because you're going to draw down effectively that much every year.
Right.
You're going to reverse engineer the pot to be big enough that you could live like you live today. And so therefore you need to figure out what that rate of return is going to look like. And that's, I mean, I help a lot of people like figure that number out, exactly that.
And do you, I guess two things I get factored into that. Do you use like the, what is it, 4% as a safe withdrawal rate, or
that's like, yeah. So I think that's the quote unquote industry standard.
Right. Yeah.
And I tell people the following. Okay. First and foremost, if you start with that and that's your benchmark, you at least are like 85% ahead of the game. Right. Because most people don't even have that. So that at least becomes your guiding light. If you want to make it a higher number, meaning like a lower percentage, you're actually going to pull bigger dollars out. Right. So the 4% number is basically like the reverse way to do it is you multiply that expense number by 25. It's the same thing. It's the inverse of it. So some people are like, okay, you know what? I'm going to multiply the number by 33 because I know that like I want to be able to pull out more money. The reality is like everybody at the end of the day, like I know this is it's not so funny, but it's kind of funny. And that is like, if you look at these models and you look at all these things, blah, 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 and they're like, okay, it works for 96% of the population, or it works for like, guess what? Right. You are one of one.
Yeah. You can't be the 4% that goes bankrupt.
Correct. Exactly right. So the 4% rule totally works and it's great. The key though is to check in on it every 5 years, meaning has your spend changed? Does your dream lifestyle look different? Because the truth is like what you think at 25 or 30, by the time you're 40, you may have a different view on like what your dream lifestyle looks like. You may become more minimalist or you may become more extravagant, and you don't know, like you could tell yourself, oh, I'm going to be like this, but you never know what's actually going to happen. Right. So I think some people are like, hey, I'll build my portfolio to draw down this 4% number. Right. So like there's lots of different ways to do it. The S&P 500 is one, dividend paying stocks is another. Then you can juice the returns on dividend paying stocks by basically doing something called like selling covered calls, which you're basically renting out your stock. So I own the stock and someone pays me rent to use it for a little bit, and you generate additional returns on like that. But the dividends effectively could potentially be that apartment building for you. And I think a lot of it, and who the heck knows what's going to be with what in crypto, right? Like whether it's Bitcoin or Cardano or Ethereum or whatever it may be. But and now the one that everybody will talk about is like Solana. But the interesting thing though is that a lot of it has to do with your risk profile. If you can't handle certain volatility, then that asset class may not be what's best for you. Because at the end of the day, if I say to you like, oh, do this, and you wake up in 2 months and it's down 20%, are you going to have heart palpitations? Or are you going to be like, I'm okay with that because I have a long time and whatever? Like you have to kind of know yourself, and different personality types react differently to different things. And so therefore, like I can't give you like a blanket here, do this, or whatever it is start putting the money into some sort of vehicle. And a vehicle doesn't have to be a 401k or an IRA or whatever, but just into the market. You'll also learn a lot about yourself by doing this. Like if you do $100 a month into like a Vanguard or an S&P, anything, whatever it is, you're actually going to find out how you feel about this, about
like risk tolerance. And so let's use an example. We can use myself as an example to make it more tangible for the audience. You can tell me what I'm doing wrong, or if I'm not. So I have
how perfect you are.
Well, hopefully, I don't know, we'll see. Or like just to use it as an example, so I have student debt from like I took out close to $200,000 in loans that I had been paying off because it was like 6 or 7% with some of the cash flow that I make from my company and just other side hustles.
Okay.
Now, I always had this debate, like, all right, should I just put everything into market? But I was able to like split it. So I was like, all right, maybe I'll still pay off some of the debt. Now, since it's been at 0% interest recently, because that was the whole
forbearance for COVID.
Yeah, exactly.
Yeah. Nice.
I haven't been paying as much off.
Okay.
But
so let me ask you a question. Let me ask you, how does that make you feel that it's not gone down?
The student loans?
Yeah. Do you care?
Not really. I mean, I was paying off a decent amount, and then I'm putting the money elsewhere. So I just look at it from like a net worth perspective. Yeah, exactly.
That's fine. Like a lot of people have a hard time disconnecting from that. So that's why I asked.
Yeah. I mean, I think though, because I've gotten it down to a lower number, that was the thing. Like, I feel like it might be different for me if I had $500,000 in debt and I'm not paying that down because I think I'm getting better returns at the S&P 500. That's where I'm like, I don't know if I would be able to handle such a large number that doesn't start to go the other direction.
Yeah.
But, and also like, depending on the payment plan you take, like you'd have to be paying something down. But with where it's at now, like I'm totally fine with.
And are you putting the money into a Roth IRA?
So yeah, so that's what I was doing.
Okay.
So basically I had been putting money into a Roth. Then
Okay.
once I was making enough money that I was doing a backdoor Roth. So that's like the first step of where my money goes. Then it goes into.
Let me ask you something for your listeners. I don't know if you've ever talked about it a lot. Did you ever break down how you created it and what you did to create the backdoor Roth?
The Roth. So I do it. I used to use Vanguard and then I switched to Schwab.
Okay.
Not like just for the reason is it's not like a big deal. I just had to switch it over to Schwab. Which they're fairly similar. So basically I put the money into I believe a traditional Roth IRA, and then a traditional IRA, and then I take all that and I put the exact amount that I can essentially put into a Roth, and I transfer it to the Roth, and then there's like some tax form at the end of the year. And you have to make sure also that the traditional IRA, the balance goes to zero pretty much every year. So it's like open just for the purpose of switching it over to a Roth.
Right. Okay. Yeah. I didn't know if you've ever like kind of talked about it enough on your podcast for everybody to know exactly what you're doing. But yeah.
No, I generally haven't talked about like what I do with finances on this. Will probably be the first episode. I'm sure there'll be lots of nosy listeners who are interested.
Yeah. Very honored. Okay, great.
Yeah. So I do that. Then the next thing, once I had enough income that I needed to put it somewhere else, was to put into the individual market. Most of it goes into the S&P 500. And then now do
you manually do this like on hey, I brought in this money, let me do it, or is it automatic?
So it's all on Schwab. I try to, now that I pay myself a salary through my company. At first I wasn't even really paying myself much of a salary. I then take a certain percentage of that salary and I put it into my individual portfolio.
Sure.
But then I also have an individual 401k. So I'm trying to max that out from a tax advantage perspective so that I'm not paying
a solo 401k via your business.
Exactly. So it's through Schwab, and then there's like an employer match and whatnot.
Right, because you are the employer.
Exactly. So I can kind of determine what that match is. So I basically try to get as much into that as possible. And then if there's left over, it essentially goes to the individual my just individual brokerage account, which most of it's in S&P 500, as well as most of my 401k is just S&P 500. And then crypto. I split it with crypto assets, Bitcoin, Ethereum, Cardano, which has been pretty good for me thus far. What I've learned with crypto is I have a pretty high risk tolerance.
Okay. And I would guess my view on crypto, especially let's call it the big caps that you've mentioned, right? Like we're talking about larger, bigger projects, bigger name coins that are now essentially household names. Versus, basically going to the casino and gambling.
I don't really dabble with any of that stuff. Like I bought Bitcoin, Ethereum, Cardano. The assumption is that I hold it for 20 plus years.
Correct. Right. And so I think that is the exact point I was going to make. And that is you're playing for the long game. You're not trading it. You're not looking to get a pop out of something. You're just buying. And when you split, do you just like it dumps into the S&P 500 every month, it just goes and buys automatically? Or do you have to manually do this?
I was putting a lot of money into it when it was all lower. And I was
like this year,
like in the
30s?
So nothing. Like I'm not a secret crypto multimillionaire or anything like that. No, so I was putting in when it was like about, if I want to go back to, let me see my Coinbase. I want to say like the first time I ever bought, but it was such a small amount, was like 14,000. And then I really started buying around 30,000, and for Bitcoin and Ethereum around,
probably 12 to 1800.
Yeah, not even. And so I was putting a lot of money in at that point. And then, but I felt like I was putting so much more into there than it was like my individual brokerage and 401k. So I was dollar cost averaging at that point. Then I like pulled back on that. And so it wasn't going in like on a routine biweekly basis. And now I just recently again started to put at a smaller amount into each of those assets, like on a weekly or biweekly basis.
No, that makes sense. Okay. So you mentioned Coinbase. Do you use Coinbase or Coinbase Pro?
I use Coinbase, which I know I just spent way too much money on fees, like huge mistake for no reason.
Yeah. And you can transfer, by the way, from Coinbase to Coinbase Pro for free.
It was extremely dumb. I opened up Coinbase Pro. So now I think I have that, but it's like the most, I spend way too much on fees buying.
It's very funny. You're not alone. I think it's very common, and it's crazy that they have this business that, for anyone who's listening, like if you are not a crypto enthusiast, or you are and you use Coinbase, the fact that they have this other platform called Coinbase Pro, which they allow you to kind of toggle between the two in the sense the money can go back and forth for no transfer fees, no anything. And ultimately, the user interface is definitely different in the sense that Coinbase is a much user-friendly, beginner-friendly, interface. And that's where they let you like learn videos and get paid, a couple of dollars and some coins to get paid in these videos. But outside of that, the only difference between the two is Coinbase Pro really allows you to basically create limit orders, meaning like you can set the price versus Coinbase, it's transacted basically what I would call a market order. It goes out whatever it is. And the fees between the two are like night and day.
It's almost like it's 100%. It's like a 50% difference. I think it's
more
literally double.
I think it's more than double now. I feel like I think the Coinbase Pro fee is something like 50 basis points, like a 0.5%. And I feel like Coinbase, I mean, they used to be like 3 to 5%. So if it's
it was never that high when I was buying. Maybe like let's find out right now.
I feel like
it might have been like 1.5. It might have been like 1.5.
Yeah,
which is still triple.
Correct, exactly. And what's also interesting is that for Coinbase, that because you do a market order, right, and you can't do a limit, they actually can transact it wherever the heck they want. There's no way to like verify. Like you could basically pay $6 million for like one, and they kind of bring it back. But okay, so you were doing that. Now you're back to dollar cost averaging. All
it's
good.
Like 1.5.
Yeah. Okay. So
but I have to set it up on Coinbase Pro. I'm gonna go set it up on Coinbase Pro after this.
Okay, cool. So when you look at your, basically, if you look at your quote unquote pie chart of assets, crypto as a percentage of total assets, what do you think it is right now? Ballpark?
Well, it was 25% just about, but now it's probably 50 because
of the run
of the run up. Yeah, and right as we're speaking, it's what's today's date? Like September 2nd, and we're getting back closer to all-time highs.
Yeah. I mean, like Cardano's at all-time highs.
Yeah.
Ethereum is is knocking on the door. And what do you call it? Bitcoin's
not
at
like
there.
50K.
50. So. Yeah. They're at like 50 versus the 64 that it hit, So like we've definitely seen a run up, right? So as a percentage of assets, it's high, right? Like there's no question.
So it's very high. And I'm not counting the cash that's in the business, even though that's I consider that what hopefully will go and continue to reinvest into the business.
And even if you don't reinvest it, if you take it as a distribution later, that's fine as well. Like don't include that for now because you have no idea.
Right, exactly.
Like you may do some major marketing spend and whatever. Yeah,
we try to keep it in there just so we can continue to reinvest.
Yeah, interestingly enough, I think I've always said this, but I think COVID drove this point home. And that is like a lot of times, like in your personal life, you generally want what people call it different things like sleep well at night, emergency fund, whatever it is. Like basically you want like anywhere from like 3 to 6 months of living expenses, just kind of sitting idly in cash type of thing. And I have like a little nuance on that I'll tell you after. But for a business, the mistake that a lot of businesses make is they don't have that either. They need that same 3 to 6% of operating, 3 to 6 months of operating expenses. And COVID taught a lot of people the hard lesson that they had 6 weeks of cash on hand. And how the heck were they going to get through it because their business shut down and they had no cash flow coming in, right? And they couldn't really weather the storms and stuff like that. So I always tell people also that's also out 3 to 6 months of operating expenses outside of advertising costs, because that's the easiest thing to shut off. Like if it's not working, if you're not seeing an ROI on it, you could just shut it off. Like even if you tell me you're running Facebook ads for whatever, doesn't matter.
Right. Technically ad costs should be profitable. So
at a minimum break even, right? Like, and so, from all that perspective, it's totally fine to keep it in the business. So 25%, obviously when it was lower, north of that, closer to 50%, it's definitely a high number. Now, granted, depending on your, I know your age and your listeners know your age, but depending on the person who's listening, they may want to pare that back.
Yeah. I wouldn't recommend it. Not that I'm the financial expert, but I wouldn't recommend it to my parents or to someone that's 50 plus, right? They're 50%.
So it's funny, my dad in particular, let's use him, right? He's 76 years old. He and my mom, I have them, the guidance I gave them is they should have 1 to 10% of their net worth in crypto, right? Yeah. Because I think it's a long-term asset that they should own. That's what I said but it's going to have as well. Wild volatility. Right. So I think you have to know yourself in the sense that you're young, but if you can't handle that volatility or you can't just be very disciplined about it and just put it in and forget about it, then you need to probably keep that at a lower. But entrepreneurs in general, right, are risk driven. Like
Yeah,
their makeup
that's 100% true.
And so therefore, like when they hear about things that are like high risk, high reward, they're like naturally drawn to it. They're like, no, give me 100% of that. Don't tell me to like scale that back. And that's like the NFT market, right? Like who's playing in it? Not
Yeah, your
the the
casual,
boomers
it's
and
not,
whatever.
yeah.
And listen, there's going to be a lot of people make a lot of money in the short term. There's going to
And
be a
definitely
lot of people love to lose a lot of money.
Yeah, 100%,
Right?
100%.
And this is the thing. I actually have a podcast, and I not this episode, the last week's episode, I actually called it like the dark side of investing. It's if you go on social media or you go on these things, all the people are always talking about their wins.
Yeah, because
right?
you only see if someone did well. Exactly.
Yeah, nobody's going to show you. Yeah, I just lost like 50% of my money or 100% of my money and whatever. So I think what you're doing actually makes a ton of sense. I actually think that, like, let's say the thesis works in the sense that the crypto doubles, triples, quadruples in value. Okay. I'm not telling you to ever sell it, but if you needed to pay off the debt, guess what could pay it off? Right. Like you, in theory, could buy it, but you could probably borrow against it.
That's what I was about to say. Like, wouldn't it, I don't want to pay the capital gains tax on that. Wouldn't the best situation be I borrow against it at a lower rate and then pay off, let's say, my medical school debt?
So first of all, make sure it's a lower rate. You should get a lower rate, but make sure it's a lower rate. Yeah. So it's very funny. Michael Saylor, who I don't know if your listeners know who he is. Michael Saylor is the CEO.
Maybe the ones that know that are invested in Bitcoin might.
Right. Okay. So he's a CEO of a publicly traded company called MicroStrategies. MSTR is the ticker, and he is a very large, outspoken proponent of Bitcoin. So much so that he's taken his company's cash and put it all into Bitcoin. Then he went and raised more debt for the company and he put it all in Bitcoin. Then what did he do? Raise more debt, put it into Bitcoin. Finally, he said, hey, Elon Musk, I could show you how to do this, because Elon Musk asked, does anyone know how to buy $1 billion of Bitcoin? And he showed Elon Musk how to do this with his company, with, Tesla's money. And then what did Michael Saylor do? He basically put the playbook of how to do this from a corporate accounting standpoint on his website for free, right? Then he went and borrowed more money and put it all into Bitcoin, right? So he's all in. He says that he believes that no one's ever, like, if you own this asset, don't ever sell it, just borrow against it. And it's like one of these unknown things that, like, I think, again, unless you hit a certain wealth number, people don't realize this, but like you actually, this is not just a Bitcoin thing. This is any
borrowing against assets. Yeah.
Correct. Borrowing against assets is like one of these like sneaky, quiet industries that people don't really know about. Nobody really talks about. And even, again, referencing my parents, they were swapping out of one house into another house recently. And my dad's like, well, I'm going to sell some of, my stocks and, kind of bridge the gap in what we're selling. I'm like, why? He's like, why not? I'm like, well, why don't you get a little bit of a mortgage? It's 3%. It's not even like big deal. And so first of all, pause, there is psychology in there, right? Like he's of a different generation, he's taking on debt, right? In my head, I'm like 3% debt and you have assets appreciating anywhere from 10 to 50%. It's a no brainer, right? So, that aside, he could have also, like most of these brokerage firms, or you can go to a bank, they'll lend on this stuff. Like there's a whole industry that, especially when you're a certain net worth, they'll lend it at like ridiculously low rates. Like they use this thing called LIBOR, and LIBOR is like whatever, under 1%. So it's like LIBOR plus something. So even if LIBOR plus 100 basis points, you're paying like 1.1 or whatever, 1.5% if you have enough money, obviously. So eventually the thesis is, right, like Bitcoin is going to be one of those asset classes that are going to be able to be lent against.
And right now, though, I don't think we're there, because if you go to, like, I know Coinbase has their lending option, right? So I got all excited. I was like, oh, let me see like what percent loan I could take out. It was 8%. It was technically higher than my student loans right now. It was like,
which is why I said, be careful of the rate, because also, I've seen a lot of these other platforms that have lending against these things. A lot of times they sell it at 1%. They sell you on the concept of 1%, but the print is 1% a month.
Wow.
So it's really like 12% a year,
That's a big difference. That's slimy. So, okay. So what things then would you say I could be thinking about to maybe the 50% is aggressive. My goal is to get away from that, maybe closer to 25, 30.
But to your point though, just to highlight one thing about you said, it's a lot of it's due to appreciation.
Right. That's the thing. It wasn't because I put in principle 50% of everything I had. It just, because it went up, and I'm sure it'll go down a little bit, and then it'll be a different percentage percentage and then it'll go back up.
Right. So if you're allocating, right, like if you're like, hey, I'm bringing in $1, right, you're really only putting 25 cents into the Bitcoin pile, into the crypto pile, right? And you're putting 75 cents into the stock market pile.
Exactly. So then what are some other things that you speak to clients about that, or like someone like me would be looking into, whether that's, I mean, some of the things that I've looked into once I max out the retirement accounts and put money into both crypto and individuals, like some potential angel investing, potentially real estate, other things I probably have no clue about. Those are the things that now I'm thinking, all right. And then obviously trying to get my student loans paid off.
Yeah. So the student loans, like I think also once you start cash flowing more, meaning you have a job, you're going to be able to allocate differently. And if you're running this business and job and your medical job, you can start to reallocate. And like I said, you could, in theory, if you wanted to, not advising it, but you could pull out that principal on the Roth side anyway, without penalties or whatever, if you needed to make pay downs or whatever. In terms of the asset classes, so angel investing, I do personally, full disclosure, I do angel investing, and I've been active in it a long time, but I also worked professionally at a VC for 3 or 4 years. And that doesn't make me any better than someone who didn't. Like I'm not saying it from a perspective of like, hey, I know more. But it's very funny. If you talk to anyone who does angel investing and you say, why do you do it? Like, what are the reasons? What is the reason you do angel investing? Right? It's never one thing. Nobody ever says to you, it's because of X. Ask anybody who does angel investing. They will give you a list of 4 or 5 reasons. They do it for the returns. They do it for the networking. They do it to see the new technology. They do it to stay up on current trends or whatever it is. They do it so they can have a good story at the next party, right? Mm-hmm. Anything you do that has 4 or 5 reasons, that means you're doing it for none of them. I know that sounds really like crazy, but why do you invest in the S&P 500? For one reason, because you want it to go up. You expect it to go up. You think over time it's going to make you money. Same with, crypto. Angel investing, there's a 9 out of 10 chance that this company is going bankrupt. Yeah,
you're losing that investment.
Right? And so people take the, spray and pray approach where they're going to put the money everywhere and hope that one of them really hits and makes up for the entire portfolio. So if you get to a point where you're like, hey, I have a lot of money and I want to start doing this, you actually, the biggest challenge that people have is it becomes a little bit of like a dopamine hit, like it's a little bit of adrenaline rush. Mm-hmm. And because you could join these syndicates and they start saying all this and everything sounds like the next best thing, right? So it's like FOMO, right? And the first thing is like it can get out of hand pretty quickly. And it also like you kind of need to reserve some money for the follow-on round because the company's probably going to raise more money again. And if you don't want to get diluted, you're probably going to need to ante up.
Interesting.
And you're going to want to ante up in the winners because like, let's say the first investment was at 10 million and now they're doing it at a 50 million. Now it's 100 million. If you don't, right, like this winner is something you're interested in, you don't want to keep getting diluted. So, that's just another thing to think about. And so you have to be very careful in saying, okay, I have X dollars for this strategy. It becomes like another asset class. So I actually am while I do it and I have all the same 4 reasons, 5 reasons that everybody else does, I am not a proponent of telling people that this is a good deployment of capital.
A viable strategy. Yeah, that makes sense. I mean, the opportunities that have somewhat presented itself to me and also that I was interested in is like companies within my niche of academic advising that I could potentially help grow. And that also just like makes sense. And also just like, I love business.
Yes, me too. I'm with you, but a lot of times though, that doesn't necessarily make it a good investment. Maybe it becomes a good advisory role. Maybe it becomes getting some free equity or taking less cash and some equity. Or if it's like, I actually like buying smaller local cash flowing businesses, like
that makes sense.
I know this is going to sound like, like Monday laundry-ish or, fronting things, but like, laundromats, car washes, pool services. These are much more predictable cash flow, like service businesses that have predictable cash flow that can act like almost like a real estate piece or things of that nature. And you're not taking on the venture risk of a startup.
Yeah, it makes
right?
sense.
Like, and you can basically buy another one and bolt it on. And now you have 2 laundromats or whatever it is. I'm using that as like just a cash flow example. And like, it's funny, there's a kid in my neighborhood. He came to me and he says, I'm thinking about doing this. What do you think of this idea? I'm like, I think it's amazing. You want to know what the idea was? He literally went and started putting vending machines, food, snack vending machines in places. So for a high school kid, this was like a great side hustle, but it literally prints dollar dollar bills in quarters,
Yeah.
but there's,
Yeah.
he even spent $300 and he bolted on like the credit card machine. Like the vending machine was
That's
old and he spent money to kind of do that. Right. So there's a lot out there that you can do that doesn't have to be. Venture is just sexy because it's so hot
I guess
now.
when I said startup, I actually didn't as much mean super high risk like tech plays as much as like a cash flowing tutoring business, which is like fair,
those things are super interesting. Yeah, for sure. So real estate, I'm very big proponent of it. The thing with that though is when you're first starting out, you usually don't have enough. Like, don't go buy single family homes, because unless you want a new job to be a single family home manager.
That's the thing. I don't want to be a property manager. So I like toyed with the idea, and then I was like, this is not worth my time right now.
Same thing. I did the same thing when I was much younger. I even tried it and I was like, oh my God, I got to get the heck out of this thing as fast as possible. Yeah, sure. If I sat on that property for the last like decade or two, I would have made a killing because the real estate's gone up so much. But I knew myself and I knew this wasn't what I wanted. So the way I invest in real estate is much more with like syndicated deals, right? Someone's buying a 100-unit property. They're looking for money. So one of the challenges with those things a lot of times is that the buy-in is a little bit higher.
It's high.
Yeah.
And they have some sort of carry, right? Too.
Yeah, every deal is different and it's a split. It doesn't have to be per se a carry. But again, if someone says, hey, I can get you an annual return of, call it 10 to 15 or 18%, whatever it is, and you do nothing in theory, right? Like you're not property managing, you're not doing, I'm okay if they're going to get me that return, they're taking
fair enough. Yeah.
Right. So it's really kind of passive in that regard. So obviously you can build up to that or build relationships to kind of build to a point where you can make smaller investments, but you can also do this even in the public markets where you can buy things called Reits, right? So Reits are basically entities like, think Simon Properties, right? They own all the biggest malls, or Brookfield, or all these guys. They own properties, and therefore, if you look at those stocks, they also throw off, typically they have dividends because they're structured tax wise. They actually have to kick back a lot of the net income that they make, the profits they make, they have to give it to shareholders. So again, it may not be as sexy as owning a mall down the block, but if you are a shareholder in that, that's like could be the beginning of foray into getting into real estate, as opposed to like being a property manager at a single family. Because like if you look at people who are in real estate and you see the wealthiest people, do you know any of them who actually manage 100
They're not
family?
Yeah, exactly.
Yeah, or even own a business that owns 100 single family units? Not usually. These are good like hustles. These are good income producers. But long-term big wealth, like even with Airbnb, if you own a whole bunch of properties, how many people really have mega companies doing this? Not too many, but there are plenty of people who have made millions upon millions, if not billions, in pure real estate, like actually owning a building or owning an office or a hotel or stuff like that.
So what do you say would be like the best for someone who's now at the level where they can put a substantial amount in? They don't want to do single family homes, but they also don't have like a ridiculous amount of money.
Yeah. So
they're going to buy a whole,
yeah. So I think going into
just REITs or syndicated deals. So.
I think syndicated deals, like finding people that you can see their track record or at least work with someone. Like when people come to me, like that's one of the things I offer. Like I'm like, hey, I know these operators, I've invested with them, and I break down the risks and the rewards and like kind of analyze the deal for people. But that will allow you to start to get your feet wet, because the other thing is like when you're younger and you're willing to take certain risks, the idea of someone coming to you and saying, hey, we're going to develop this property, oh, it sounds really attractive because like the returns are going to be off the charts. But when you break it down, a lot of times development is where things go off track, right? The cost overrun, all the stuff. And so like for me, I generally look for reasonably strong occupancy that's cash flowing day one. And that's where whoever comes to me is like, hey, I have 50,000 I can put in this. I have 100,000. I have whatever bigger number, $1 million, $2 million. Yeah. We're going to create some diversification around that as well. But yeah, we're going to go into cash flowing deals.
And then I guess the difference is, right, because let's say 15, 18, even 20%. It's not like life changing in comparison to I could just put some of that money into crypto instead that I think is going to get similar returns. But the difference you would say is one, diversification, and then two, cash flowing. So you're getting money every month as opposed to, does that make sense? You have the investment and then you're also getting a cash flow from that investment.
So it's two things in the sense that like crypto right now, granted things could change and smart contracts, whatever, but right now it's an appreciation play.
Exactly.
Right. Yeah. Whereas real estate's a cash flow and appreciation, and it may be a modified one. The other thing though is volatility is totally different. Just like from the perspective of, but there's also another difference that crypto has that the real estate doesn't, and that's liquidity. You can't typically, when you get into these real estate deals, you have to expect 5-10 years that you won't see the money back. And maybe they'll refinance you out in years 2 or 3 and you'll get half of your money back or 3/4 of your money back. But these are all kind of parts of the equation of like, when you write that $50,000 check or $100,000 check or $1 million check for a real estate deal, even if you're not the operator, you better know that like you'll get quarterly distributions or monthly.
But you're not seeing that for,
yeah, but you probably won't see a chunk of money for at least a couple of years.
And then is the goal, aside from the fact that, you're getting cash flow from it, that they're eventually going to sell that and then you're getting your principal investment back plus what you make? Or is it just like you're going to continue to get cash flow, and then let's say you ever needed that million, are you able to sell that million, let's say, that you put into it? Or how does that if it's a syndicated deal?
So if it's a syndicated deal, you don't control when they sell the property, right?
Right.
So if you're at a point where you're like, oh my God, I need that $1 million, right? You can go to them and they potentially will buy you out. They potentially can offer it to other members of the syndicate, or they can tell you go fly a kite. Right. And so first of all, the legal docs will tell you what is and isn't allowed, but there's no guarantees that they'll, even if it says you could sell to another member, it doesn't mean that they're going to buy it for $1 million. But to your actual question of, you're seeing, let's say, quarterly distributions, right? So you're getting money. Yeah. The big bump is going to be one of two things, whether they refinance the loan and then they do a cash out refinancing. And then at disposition on sale, you're going to get a big bump as well. But in the meantime, though, you typically are not needing that cash. So the cash flow is getting reinvested. Like when you're getting those distributions, you generally want to be putting them in a pot that's going to go be redeployed. So it's definitely a different thesis than like, hey, I put it in crypto and I need the money, I can pull it out type of thing.
Yep. Interesting. Okay. Well, seems like not something I will personally be doing right now, but a different avenue for, as people are becoming physicians or the entrepreneurs listening to this, they're making so much money, they don't know what to do with it. Another great avenue. Awesome. Well, I appreciate your time. I know we went a little bit over. This was very helpful, both for me and hopefully for all the listeners and viewers, regarding things that they should be thinking about with their money, even if you're just getting started, whether it's opening up a Roth IRA. The earlier you start, as you talked about earlier, compounding interest, the better. Thanks for coming on. And where can the listeners find you?
Sure. My pleasure. The platform I probably am the most active on is Instagram. So Aryeh the Businessman is my Instagram handle. If you want to learn more about working with me or just some things about me, solutionadvisory.com. And then the other place is probably futurefundme.com.
Awesome. All right. Thanks so much. Go check them out. And I'll see you on the next episode, everyone.
Thanks so much.